Welcome to the CARI, the third CARI live webinar. This is actually the start of the 2000 to 2001 academic year, which started July 1st, but we really are thinking of this as the third in our series from the spring. So today we're really thrilled because we have a wonderful menu of things for you, including the highlight of really our year, which is the launch of our interactive loan database. So I'd first like to thank the Carnegie Corporation of New York, without whom our work would not be possible. And my wonderful team here at CARI, including Marie Foster and Yoon Jung Pak and Daniela Solano Ward. And then the two researchers will be introduced in a minute, whose faces you see up here. But let me introduce the moderator for today's event, Kevin Gallagher, who's a professor of global development policy at Boston University and an old friend of the China-Africa Research Initiative. He spent a year at SAIS a few years ago, so we know Kevin quite well, and we're thrilled that he agreed to moderate this. He directs the Global Development Policy Center at Boston University, and he's also the author or co-author of 6 books, including The China Triangle, Latin America's China Boom. And I think importantly for our topic today, it's good to know that he serves on the United Nations Committee for Development Policy, and he co-chairs the T20 Task Force on International Financial Architecture at the G20. So thank you so much, Kevin, for being here, and I'll turn it over to you.
Thank you, Deborah. Good morning, everyone, where it's morning. Good afternoon, everyone, where it's afternoon, and good evening, everyone, where it's good evening. It's an honor and a privilege to be able to moderate this really momentous and historic and couldn't be more timely event that we're going to have today with jointly the launch of CARI's new interactive database that goes from 2000 to 2018 on Chinese loans to Africa, and a paper that helps us make sense of it all, especially in this pressing time that we have, called Risky Business, that describes the database and some of the implications for Africa's debt concerns that we're living in right now. The program today components, I'll quickly right now turn it over to Kevin Aker. Kevin is CARI's research manager, and he's going to unveil the interactive web portal for us. And after that, we'll have some we'll move on to a presentation by Deborah Brodigam, who just introduced herself, as well as Kevin and Yufan Huang, who's also on the CARI team and moving over to Cornell to get a PhD. So without further ado, let me move on and introduce Kevin. Please let us see.
Thank you, Kevin. Just share my screen. All right, so welcome everyone. As we mentioned, today we're launching our interactive database, which I'll walk you through in a moment. And I'd also like to acknowledge Professor Gallagher's own interactive database on Chinese loans to Latin America, which is a big inspiration for this project. So this is a big moment for us. Before today, the only data publicly available on our website was our annual aggregate loan data. But the aggregate data is compiled from a back-end database of each Chinese loan to Africa that we have tracked over the years. We have released this data to some researchers who have requested it for their work, but today, for the first time, this loan level data will be made public and available for download online. So I'll start with a little bit of background on China-Africa Research Initiative and on Chinese loans to Africa in general. So Chinese financiers are not very transparent and do not systematically provide data on the individual loans they offer to overseas borrowers. In order to better understand the role that Chinese play in China-Africa relations, African development, and African debt issues, our director, Professor Brodigam, started to collect this loan data herself in the 1980s, mostly through fieldwork. In order to institutionalize these data collection efforts, over the years, she's assembled teams, and since coming to SAIS, mostly of SAIS students, to investigate and collect data on Chinese loans to Africa. Since then, CARI teams have identified over 1,000 loans worth approximately $148 billion from Chinese financiers to African governments and their state-owned enterprises from 2000 to 2018. Our researchers follow a rigorous methodology, which you'll find here on the website, and I'll also talk a little bit about in a moment. Our data is collected mostly from open source research and supplemented in fieldwork in interviews with contacts in Africa. So our work starts by collecting reports of loans, often from media sources, and from there each loan follows a life cycle. First, each loan goes into our database as unconfirmed and does not enter into our totals until we have found enough information to be confident that an actual loan agreement was signed. In order to confirm that a loan agreement was signed, we need to find official sources. Most of our loans are backed up by official sources, and this includes things like Ministry of Finance documents, press releases from Chinese banks, or releases from Ministry of Commerce units at Chinese embassies in Africa. And it's really important to find these things because a lot of what is reported in the media does not actually turn into actual loans. A lot of reports are based on vague MOUs agreed upon between African and Chinese leaders at, for example, the Forum on China-Africa Cooperation, or based on wish lists of African government officials who say they're going to try to get financing for certain projects. A lot of this doesn't actually happen. Once we do confirm that a loan has been signed, we track it through the life of the project that the loan is financing, if possible. If we find that a project has not happened, we remove the loan from our database. And this is because if a project doesn't happen, the loan won't get disbursed to the borrower. So moving on from this, it's important to note that our figures should not be equivalent to African debt to China. Many loan commitments are only fully disbursed 5 to 6 years after they are signed. Many are repaid and some don't get disbursed at all. So for all these reasons, it's not uncommon for outstanding debt reported by African countries to China to only reach half of the total loan commitments that we track between 2000 and 2018. So before going into the data, I'd also like to mention that this is an imperfect science. Not all loans are easy to find and much less easy to confirm. So if you are familiar with loans to a particular country and do notice mistakes or omissions when you're exploring the database yourself, please do let us know. Now let's take a look at the data. Our data includes lending to 50 countries in Africa. Only 4 have not received loans from China between 2000 and 2018, and we can talk about that more in the Q&A if you're interested. On the interactive portion of the database here, you see the map of Africa, and you can also see each country in a list form. You can also search for a country that you're looking for. If you want to see the loans that have gone on to a particular country over each year, you can click on that country. And then you can also filter by the sectors the loans have gone into and by the years. So for example, we can see all the loans that have gone into the transport sector over the years in each country, or the power sector. We can also zoom in on particular years. And for example, 2016 was the biggest year where a lot of money was going into Angola. You can also select all 3 filters to find some interesting things. For example, if we go into Ethiopia and look at the transport sector, we can see here in 2013, the loan for the Addis-Djibouti Railway, which was just completed in 2019. Another interesting example is Zambia. If we click on Zambia and go into the power sector, we can see here in 2017, the loan for the Kafue Gorge hydropower project, which is still a work in progress. Once you've made your selections, you can open the data panel and download what you've selected. If you'd like to download all of the data, you can reset your filters here. And here in the middle, you can see the amount of the loan, the country it goes to, the sector, the purpose, and the year. But we also have more data available for download as well. When you download the Excel version, you can choose to download a number of other variables, including the loan ID, which is a unique ID assigned to each loan to identify each loan. The status, which includes signed, implementation, and completed. And this is important because signed loans can eventually be removed from the database if they never move in to implementation. You can also see the borrower of each loans. And this is really important because we do track loans not only to African ministries of finance and central banks, but also to African state-owned enterprises or joint ventures or special purpose vehicles where African governments have ownership. And this has implications for understanding outstanding debt data because different countries record this kind of debt differently, and sometimes loans to state-owned enterprises won't necessarily show up on the central government's books. The next 2 data points are the lender and the type of finance. We have over 30 different lenders in our database. And these include the Chinese policy banks like the Export-Import Bank of China, which provides things like export buyer's credits and concessional loans. Commercial banks like the Industrial Commercial Bank of China, which provides commercial loans. And we also have more than 20 companies, Chinese companies, that lend suppliers credits to different countries in Africa. And this also has implications for how we track debt. Loans from commercial banks in China and from Chinese companies won't necessarily show up as bilateral official debt in debt statistics. Next, we have the amount of the loan, and we also track the terms of each loan. You can find the interest rate in the interest rate column. And if the interest rate is based on a benchmark rate like the London Interbank Borrowing Rate, we also record that here. We also include the data on grace periods and terms if we can find them. The grace period is a period of time that a country won't have to pay on the principal of the loan. It's usually about 5 or 6 years, and the term is the total number of years that the country has to pay back a loan. So that is our interactive database in a nutshell. We're really excited to give you guys an opportunity to look at it yourselves. But first, I'll turn it back to Kevin, who will introduce our PowerPoint presentation.
Thanks so much, Kevin, and congratulations again to the whole team. This is really the gold standard of the approach to try to create transparency about Chinese overseas lending. And as Kevin mentioned, Deborah Brodingham has been leading a team who's been doing this for decades. He also mentioned that at the Global Development Policy Center, we have a number of databases, and we've tried to mimic your methodology of double verifying all of this stuff to make sure that we can get to become as good as artists as we can. As you mentioned, this is an art and certainly not a science until it starts to be uploaded like, say, the multilateral development banks do on their pages. With the Inter-American Dialogue, we co-publish a similar database on China, Latin America. You can Google it to find the China, Latin America Finance Database, but just to sort of show some of the relative numbers, Kevin and company see, I think you said about 148 billion for Africa during this period. What's interesting is Latin America is around the same amount, about what we estimate it's around 137. We also maintain, in partnership with CARI, China's Global Energy Finance Database, which looks at the entire world in terms of Chinese overseas finance and energy. We see that at around 251.3 billion, but that's just the two policy banks. One of the other new databases that has just come out in the past couple of weeks is a new one by the World Bank, the DSSI database, which allows us to look at what some of the poorest countries owe in all of their external debt over the next couple of years. And that's why I think it's so great and so important that this team is coming out with this data now, because Africa has quickly gone from being the continent on the move to the continent on the decline. The International Monetary Fund just re-released its World Economic Outlook projections earlier this week, and has already downgraded what were already bleak projections for what African growth prospects look like over the next couple of years. It now sees a contraction in 2020 at about 3.2% for the entire continent, but in places like sub-Saharan Africa, upwards of 9.7%. So the country is, the continent is in quite dire straits, and a big component of that is, or a big dynamic related to all this is the extent to which the region has excessive amounts of external debt. A number of countries are in real debt distress. And so to have hard numbers that allow folks to have evidence-based conversations about the extent to which Chinese debt is a major component as part of a strategy to try to alleviate debt distress and fight the virus and put the region back onto a sustainable recovery. So this couldn't come at a better time. In addition to the actual hard economic strife that the region is undergoing, we're also undergoing a period of heightened U.S.-Chinese tensions and that unfortunately is laying prey to narratives that aren't necessarily based on data. And so you folks are doing a great service here by providing this hard-nosed data so folks can have an evidence-based conversation both in the region, in China, and across the world about Chinese debt in Africa and the role it does and can play in a recovery. Deborah Brodegum with Kevin again, and also with Yufan Huang, are now going to present a paper that helps us give a first take at making sense of some of this data in this new context. I'll turn it over to you.
Thank you, Kevin. So the paper that accompanies this data launch is called Risky Business, New Data on Chinese Loans and Africa's Debt Problem. And when we started writing this paper, we did not have the World Bank data. And so we decided to change our strategy because that data was available and to analyze that as part of our database launch. And so we've been hard at work at that over the last couple of weeks. And we hope that the paper and the presentation will prove illuminating. So as everybody's been saying, because I've been doing this for a long time, I thought I would show you a picture of what I looked like at the very beginning. This is from Liberia in 1984 when I was collecting data on the impact of Chinese lending through their foreign aid program. And that's me there, in case you weren't clear. So as we all know, debt has been a story in the past. And when I was a student in my first years as a professor, the whole story was about Africa's debt. And China was not really part of that story. But as we can see in this slide here, right now we're worried about debt and we think it's possible that numbers are going to go up. But as of 2018, in the best data that we have, the debt numbers were nowhere near where they were before. And we think there are a number of reasons why the crisis might not be as bad this time around as it was last time. And one important factor there is the global interest rates being so much lower now than they were there. But when people were looking at debt up until recently, they had really no idea. There was a lot of hypotheses and a lot of hunches about the Chinese role. And people were worried. For example, this slide from Foreign Affairs about Chinese debt could cause emerging markets to implode. But still, a lot of this was speculation. So our data has been used by many people, as Kevin mentioned, as a proxy for Chinese debt. And it really isn't, it's loan commitments. But I'm going to walk you through our database in the aggregate to show you a little bit about what it looks like. So Chinese loan commitments to Africa from 2000 to 2018. As we can see in this chart with the blue bars, it was rising from about 5 billion a year in 2006 up until a peak in 2013 when the Belt and Road Initiative was launched. And then interestingly enough, it's been going down except for 2016 and 2017. And 2016 is a particular anomaly, as we can see in the next slide when we divide the data into Angola and non-Angola. So the red bars in this slide are Angola, and the blue bars are all the other countries. So you can see here, Angolan loan commitments make up $43 billion, and this is almost 30% of our data out of 147 billion. And our data, again, to emphasize this commitment aspect of it, Kevin Acker is going to run us through an example from Nigeria to explain this difference.
Thank you, Deborah. So a really important part of understanding our data and how it fits into the picture of African debt is understanding the difference between loan commitments and outstanding debt. And we have the case of Nigeria here, which is a really good case. We have really great data from Nigeria that's issued by their debt management office. And we can track the disbursements of debt over the years as well as the repayment. So as you can see, the outstanding debt to China usually doesn't even reach over 50% of the total loan commitments. And this is because most loans take about 5 to 6 years to disburse. So in Nigeria, we have $5.6 billion of loan commitments committed over 2000 to 2017. About 600 million has been repaid, but about 2.5 billion has yet to be disbursed. And this has to do with a number of big projects that have been slow to be implemented that were signed between 2015 and 2017. So that Nigeria's outstanding debt to China only reaches $2 billion, which is less than half of the loan commitments. And this is common across Africa. And we'll look at a few more cases later.
Thank you, Kevin. So we're also going to show you what sectors the Chinese lending supported. And as you can see in this slide here, which is rather dramatic, the roads are often in very bad shape in Africa. And an old statistic from 2000, which is when the Chinese lending started to ramp up, said that about 12% of roads were paved in sub-Saharan Africa. And that's improved. The most recent data that I saw said that it was over 40% now. And some of that is due to Chinese lending. Another important sector that's supported by Chinese lending is electricity. And the slide on electricity shows that over 600 million Africans have no access to electricity. And I think this is dramatic if you compare Africa to Europe here, or even to India, another poor region. India's over on the right-hand side there, lots and lots of electric power going on. And in Africa, lots and lots of vast areas of blankness. So this slide about the Chinese loan commitments by sector shows that almost 30% is going just to electricity, and 35% is to transport, which includes roads and also ports and railway. So there are many lenders, as Kevin pointed out. We have over 30 Chinese lenders in our database, including banks and corporations, and this is just some of them here on this slide here. Political scientists talk about China as a system of fragmented authoritarianism, and we can see this playing out in many of the stories of Chinese lending in Africa. So as we see here, the Chinese loan commitments by lender, the blue bars represent China Exim Bank. And this is, China Exim Bank is consistently the really important part of the story in every country in Africa. But other banks have been coming in. And the second policy bank is China Development Bank. They do not lend in very many countries, but in some they're a very strong partner, and particularly in Angola. Remember 2016 with that Angola data jumping up, a lot of that was China Development Bank with a $15 billion line of credit. So that's a big chunk of what happened in 2016. In the next slide, we talk a little bit about, in the paper more extensively, about this phenomenon of resource secured lending in Africa. This is misunderstood. A portion of Chinese loans are secured with commodities, but this does not mean that they use a mine or an oil field as collateral, as many people think. Instead, these are secured with revenues from the sale of an export. And these revenues is a complicated process, but they're deposited by the buyer, which is often a Chinese company, into a designated escrow account with a Chinese lender. And they're used to repay infrastructure loans that were made by that lender to an African government. For example, Ghana built the Bui Dam, and they used cocoa bean exports to secure the loan in the years before the Bui Dam was producing power. And then after that, it was the electricity receipts and earnings that were used to secure the land, to secure the power project. But Ghana's cocoa farms were not used as collateral for the loan. 75% of all resource-backed loans in Africa go to Angola. And this slide, I think, again, is important for pointing out the Angola exceptionalism compared to all of the others. So all of the blue bars in this slide are oil-backed loans to Angola, and the red are to other governments. We only have 10 countries in Africa that use this resource-secured or export-secured model. And these are examples of some of them. We talk about these more in the paper, but there are a variety of different commodities. And Ethiopia is a particularly interesting case because they were able to secure 2 different lines of credit with all of their exports to China. These were mainly sesame seeds, but it also involved other kinds of exports. So why did the Chinese use this? I think to Chinese banks, when they started out using this model, which had been used actually by Japan in China, so they had experience with this kind of resource secured lending. This looked like a good way to reduce risks in countries that were not creditworthy. And this allowed lower interest rates, and that also enabled the borrower to pay for Chinese companies to carry out the road building, telecoms, and electricity and other infrastructure projects. And when we look at the blue line in this graph, we can see the value of Angola's exports of oil to China. And then the red bars are the value of Chinese lending or Chinese loan commitments. And that all looked like there was a very generous and ample supply there of those revenues to repay these infrastructure loans. It looked that way until the oil price fell and the Chinese lending rose in 2016. So some of that was actually refinancing. So that money went to Angola and then went right back to China, some of it. But as we can see, Angola had a lot of other lenders operating there and a lot of other expenses that they needed. And when their budget shrank, that created problems for them. And other countries are having the same experience now. So let's take a look at the DSSI data, the Debt Service Sustainability Initiative data that was launched by the World Bank in June 2020, so just a few weeks ago. So they published a new set of data on debt in 40 low-income African countries, and including Angola, which is not actually a low-income country, but it's part of the Debt Service Sustainability Initiative. This is not a complete match with our data for, as Kevin mentioned, we track loans in all 54 countries in Africa, including North Africa, and we found loans in 50 of those countries. But it is a goldmine of official information. And I'll point out here that 22 of these countries were considered and are marked in the DSSI or in other IMF or World Bank information as at high risk or already in debt distress. And we expect those numbers to unfortunately change for the worse as the full impact of COVID-19 is borne out. But in this slide, Chinese debt as a percentage of public and public guaranteed debt. This shows the distribution here. So in the Republic of China and Zimbabwe, a few other countries, these are countries that are already in debt distress. And then the orange bars are countries that are at high risk of debt distress. And the next slide here. One of the things that we did to analyze this was to look at the debt ratios. And we've got in the y-axis here along the left, we have debt to China as a percentage of income. And down at the bottom, it's China as a percentage of public external debt. And so this first graph is really, it's difficult to read because of Djibouti, Republic of Congo, and Angola, because they sort of skew things off. So if we take them off of the data and we look more closely at the countries that are left, we present the data like this because economists use debt as a percentage of national income as an important measure of debt sustainability. In countries with weak capacity to manage debt, the IMF recommends staying below 30%, but of income. But the real alarm goes off when countries go beyond 50% of income. So as we can see in this data here, in most of the countries, Chinese debt itself, if we're just looking at China, of course, it's part of a larger package, but it's around 10, 15%. It's not in this whole cluster, it's not going way up into the areas like where we would find Djibouti. That's a very rare instance, and it's because Djibouti is a very small country. And funding a port and a railway in a very small country, you can't fund a very small port or a very small railway. So moving on then, our colleague Yufan Huang will walk us through some of the DSSI numbers.
Yeah. Yeah. So we put together all the World Bank DSSI numbers and analyzed China's role in these debt problems in 40 poor African countries. And as you can see in the graph here, China's share maybe is not as large as a lot of media or people said it is. Because as we can see, as of 2018, China's share in these 40 countries in their debt stock is only 22%. But in terms of debt service in the next couple of years, we can see the percentage is higher because as we showed earlier, is that we saw that the Chinese loan commitment peaked at the year about around 2013. Given that a lot of these Chinese loans have a grace period of 5 to 7 years, a lot of these principal of this loan will have been due by now. Another takeaway from this data is that China already surpassed World Bank as the biggest lender in Africa, and also China is a big bilateral lender and bigger than all the bilateral lenders combined in this continent. Also, we can see from the graph here is that the size of Angola is just stunning. Actually, these 40 countries in total owe China about $64 billion as of 2018, and about 30% of that will be from Angola. From this slide, we can also see that the share of to bondholder, the debt service to bondholder is going to increase in percentage over the next couple of years. And we believe that's kind of worrying because a lot of this debt to bondholder actually concentrate in a handful of countries like Angola, Ivory Coast, Ghana, Kenya, and Zambia. For next slide. So we also, so we can see that among the 40 countries, and actually 41 because the South Sudan data is not available, but we got the percentage, is that among these 41, 22 of them have debt problems, which means that IMF put them in debt distress or at high risk of debt distress. So among these 22 African countries that have debt problems, more than half of them, so you can see here, 12 of them, actually in these 12 countries, China is a minor lender, which means that China's share of the external debt make up less than 15%. People may be surprised that in Sudan, the percentage will be so low. We believe that's because a lot of these Chinese loans would have been repaid over the year through oil shipments. And also that Sudan borrowed a lot from other lenders. For example, Saudi Arabia actually is the biggest lender in Sudan. Next. So, so in here, in these 7 countries, so among the 22 countries that have that problem, 7 of them are actually, in 7 of them, China is a big lender, which means that China's share of external debt is more than 25%. So among these 7, next slide. So among the 7, you can see that 5 of the 7 already received debt restructuring from China over the last couple of years, as we analyzed in our last paper. You can read that at length, maybe one. And also, so one takeaway from the data is that, that problem is actually quite common in Africa with or without China as a big lender. With that, I turn to Deborah.
Thank you, Yufan, for that. So we're going to do a little bit more comparison now of our data with the World Bank debt data. And we're going to point out some interesting issues that we found when we did this dive into their data and comparing it with ours. And one of those issues that we'll look at a little bit more is the issue of what is an official creditor. And what we think is that some countries are putting some lenders in there as official lenders or not putting them in. So for example, China Exim Bank, we believe is pretty much always considered an official lender by borrowing countries. But we're not sure they're always doing that with China Development Bank because China Development Bank provides commercial loans. And so some countries may be putting those under commercial lenders. And according to the World Bank's debt statistics, all commercial banks, whether they're owned by the government or not, come in as private creditors. So they wouldn't be under the official creditors. And then there's another example that we'll look at about how to treat lending from Taiwan. So as some people know, Taiwan and Beijing have gone back and forth in many of these African countries, debt, dollar diplomacy, and so on. So that is something that gets confusing and mixed up in the China data. So some of the data comes from Taiwan. We'll look at examples of that. And then some private companies, China International Fund, we think some of the borrowers have listed them as an official creditor, but they're a private company that's located in Hong Kong. And I think they might have even moved their headquarters to Singapore. So, and in terms of borrowers, there are also issues. Kevin alluded to that a little bit earlier with mentioning the special purpose vehicles and some of the state-owned enterprises. It's not always clear, and one would really need to look at the contracts to see to what extent the government provides a sovereign guarantee for these loans. And the whole purpose of a special purpose vehicle is to move debt off of the books of the central government. And so that through these public-private partnerships, we think that's also affecting some of the reporting of this data. So let's look at this. On the next slide, this is it's a snapshot of part of the appendix from our paper. And what we've done for you is to analyze a lot of these issues already. So if you look over first at the far right-hand column, China is a % of debt service due. So for the slice of countries that we have here, you can see we talked about Djibouti and Ethiopia. These are countries in which China is going to be a very substantial part of the problem of the debt service. And so these are countries in which we can say, yes, China's the factor there. But then when we move down through the others, we can see that the percentage of debt service that's owed to China is highly variable. In some it's high, and in some it's quite low. And so if we move back to the column that's circled with red here, so what this column shows us is the DSSI statistics, which would be the 2018 debt to China as a percentage of the CARI loan commitment. And we use this comparison to try to see how is our data compared to theirs. Is it in the ballpark? Are there any anomalies there that we need to explain or understand? And so we felt that if our data was between 45 and 85% or so of the debt data, then it was probably explained by the disbursement lag that Kevin showed in the case of Nigeria. So we weren't too worried about any of these here. We didn't think there was very much to explain there. But there are a few examples that we do want to explain. So Eritrea here, if you look at Eritrea, the World Bank's data is only 5% of our data. So theirs is a debt stock of 31 million, and ours is a loan commitments of 632 million. So this is actually, we do think our numbers are accurate here, and we think the reason why there's such a difference is that Eritrea and the World Bank do not have a very good relationship. Eritrea is in arrears to its official creditors, and we doubt very much that they're reporting on a regular basis to the World Bank, because they wouldn't really have a strong reason to do that. They're more resistant. So we think that in this case, you'll need to look at our data to get the real picture of what the Chinese loan burden, and it's actually unfortunate because it's probably a lot higher in Eritrea than it looks in the World Bank data. I'm going to turn it over to Kevin Acker to talk about Guinea, Liberia, and Madagascar.
Thanks, Deborah. So Guinea's an interesting case for how special purpose vehicles can affect the data, because they borrowed a big loan for the Suapiti hydropower project, but this was actually borrowed by a special purpose vehicle that has a certain percentage of government ownership. And part of the reason that the outstanding debt is a low percentage of our loan commitments, we think, is because that loan is not being recorded as outstanding debt. Another reason in Guinea and in some other countries like Madagascar and Lesotho is that most of the loan commitments in our data, or a significant portion of the loan commitments in our data, were signed in 2017, 2018. And because most of these don't end up being fully dispersed for 5 or 6 years, very few of these loan commitments signed in the past few years will have shown up as outstanding debt yet. Another interesting case is Liberia. So as you can see here, Liberia, the outstanding debt to China reported by the World Bank figures is 266% of the loan commitments that we've shown. We've actually updated it. The figure should be 55 million there. But in the next slide, I'll kind of walk you through this, and I apologize for the messy slide, but it's pretty interesting. So in the top left of the screen here, you can see the figures from the joint IMF World Bank debt sustainability analysis released in June 2019 about their outstanding debt in 2018. And as you can see, they only record an outstanding debt to China of 5 million, but they note in the footnotes that they have 85 million of outstanding debt to Taiwan. Fast forward a year to the data the IMF released on Liberia's public debt in June 2019, and we see the debt to China has increased to 55 million. And if you see at the bottom of our screen here, this is a snapshot from an interactive database, and we believe this is due to the $50 million loan that was signed in 2017 for the airport rehabilitation project. But when you look at the World Bank DSSI data, you see that they report as of 2018 an outstanding debt of 130 million. And this is almost perfectly a sum of the debt to Taiwan and the debt to China. So we think this is the case for a number of countries that perhaps don't currently have a diplomatic relation to Taiwan. And as you can see here in the footnote, they say that Liberia is not servicing the debt due to the lack of diplomatic relationship. And we know it's a problem in Liberia, and we suspect that there's a few other cases where Taiwan is being folded into the totals of outstanding debt.
Thank you, Kevin. So in conclusion, we want to emphasize a few things. The new data that the World Bank has released show that China makes up 22% of public debt stock and 29% of debt service in low-income Africa in 40 countries. Yet China's role should not be overestimated. In over half of the 22 countries facing debt distress, China's a small lender. their debt problems are not made in China. But in 7 of those 22 countries, China does account for a quarter or more of all public and publicly guaranteed debt. 4 of these countries negotiated debt restructuring with Chinese lenders in 2018 and 2019. And we expect others to be negotiating restructuring as well, in addition to the suspension of debt service. So another point is that Chinese banks do a project-by-project analysis when they decide whether or not to fund. It goes along with their development sustainability emphasis, which is slightly different from the debt sustainability emphasis of the World Bank. Even though China now has its own debt sustainability analysis framework, we think that this long history of looking at projects in terms of how they can contribute to future debt repayment abilities is still going to influence Chinese lending decisions. Another point is that only a quarter of Chinese lending is secured by natural resource exports. And so this is something that, that I think is often widely misunderstood. Our last point is that borrower governments should plan their projects better before they borrow. A large portion of Chinese loan commitments are very slow to disburse, partly due to borrowers' inability to meet their share of project responsibilities. And these delays hurt the bank lending, the contractor, and the borrower government. And they also create a lot of confusion over just what countries actually owe to China. So in conclusion, we've listed here everybody who's worked on this project over the past 13 years. And if any of you are watching today, please know how delighted and happy I am to be finally launching this database. And thank you from the bottom of my heart. Back to Kevin Gallagher.
Wow, well, thank you, and congratulations to not only Deborah Brodigan, but this army here that you're exhibiting on this slide. As I said, this couldn't come at a better time, because this is really a big picture and a pressing issue for the region as we speak. And so really encourage, there's over 255 people on this Zoom webinar here, to let it be known that you can go and not only click and learn for yourself, but you can download the data and do analysis from it, regardless of where you are in the world in these troubled, somewhat lockdown times. I've been asked to make a few comments and ask some questions internally to the group, just for a couple minutes. There's so many people on the webinar that I'd rather just open it up to questions. But as I'm making a few comments and asking a question of the group, I remind folks to go to the Q&A section of your Zoom down in the bottom right-hand corner, and there you can type in some questions, and Marie Foster of the CARI group will collate them, and then I'll ask them to the group on all of your behalf, just to make it more efficient. Well, thanks so much for bringing clarity to the size, the distribution, and the composition of Chinese commitments, and being very clear so that folks don't conflate what you have here in their analyses of what's going on right now. I think that's really important. In addition to these, to the interactive database, I really encourage everybody to go to the CARI webpage, because there's a number of working papers and policy briefs that perhaps your team can put in the chat window that folks can download to get a better picture of what's going on. I have one question and one thing I'd like to just put into context. Can I share my screen here? Yes. Can folks see this? Just to compare the Africa with the Latin American data, on the left-hand side is basically a replication of what your team has done with, on the vertical axis, total China commitments as a percentage of GDP, and on the horizontal, total external debt as a percentage of GDP. And you just have to swap out Venezuela for Angola on the Latin America end. Everybody else doesn't have that kind of exposure. This here is the World Bank debt statistics on what the Latin America story looks like. It's really a bondholder problem. There are 16% of the debt is bilateral. China is the largest amount, averaging at around 12%. And on the DSSI, there's a much smaller number of countries that are potential participants in the DSSI in Latin America. If you see here in Guyana, China's 27% of total external debt, but everywhere else it's relatively small, although Chinese debt as a percentage of, Chinese debt payments owed in 2020 as a percentage of total bilateral is pretty high in that country as well. My one sort of specific question about your data for the group is, what's interesting is that I sort of said, well, in the Latin America case, you swap out Venezuela for Angola. What's also interesting relative to Latin America, you folks find that the Export-Import Bank of China is really the dominant policy bank. It's reversed in Africa, excuse me, in Latin America, where the China Development Bank is the overwhelming large policy bank participant there. In terms of, I think it was very important that you clarified the nature of the securitized or collateralized loans, because that often gets construed and conflated among policy experts and the press. One other distinction between Africa and Latin America is that in the African cases, Deborah Brodegum noted, a lot of the collateralization, if you want to call it that, is through a wide range of products: cocoa beans, oil, sometimes diamonds, as you noticed. And in Latin America, it's all been petroleum thus far for the countries that are participating in it. So that's one set of comments and some sort of comparative context for your viewers. My question is a little bit more relative to your last webinar, just in case some of your viewers didn't see last week's. I think it's really important for folks to go to the webpage and see the group's paper called Debt Relief with Chinese Characteristics by the same group of folks here. Yesterday, the finance minister of Ghana said that the region is really in a massive liquidity and balance of payments crunch. They need at minimum $44 billion to get through the rest of the year. The IMF doesn't have a large enough balance sheet to meet all of this liquidity needs in the world economy. And many countries, especially African countries, are a little reluctant to go to the IMF for the full amount of that, because the conditional terms are often constraining for governments, and academic researchers show that sometimes an IMF program can leave you worse off than you were but when you started. There is conversation about redistributing about $260 billion worth of special drawing rights. However, African countries would only get about 6.8% of those, so that still wouldn't foot the bill, so to speak, to get through the rest of the year to fight the crisis and protect the vulnerable. So the last bucket of opportunity is debt relief. We know that the Chinese have obliged to play a role in the G20 DSSI initiative, but that only handles a handful of countries. It only goes through the end of 2020, and there's a bunch of other countries that aren't in that. To sort of bring back a couple bullet points from your last paper, what is the likelihood that China would support of an extension of the DSSI into 2021? And what is the likelihood that China would support an expansion to the other countries that need it just as much? And if they did, in what form? And then this is what your other paper is all about. In what form might you expect Chinese debt relief to play a role in? So if you folks can answer that, I'll then start collating some questions, and we'll have a good half hour to engage with everybody on the webinar. Thanks so much, and congratulations again, folks.
Thank you so much, Kevin. It's great to hear your comments and also to see the comparison with Latin America. And just to say again how much we value our cooperation, our continued association with you, and the mutual learning that we've done through comparing Africa and comparing Latin America. So thank you for that. I think it's, let me follow up first on something that you mentioned, which is just to point out why I think Africa and Latin America are different in terms of the dominant lender. Because as your slide pointed out, African governments are I mean, Latin American governments are going even more to the market than African governments are. The economies are far more developed. You have a lot more of middle income or upper middle income countries with pretty strong governments with a lot of capacity and ability that's been honed over many painful years to manage some of that, perhaps in better ways, although we can see there are exceptions, as Venezuela there. So China Exim Bank is the dominant lender in Africa. And their dominant instrument in Africa is the concessional loan, which is a foreign aid instrument, or the preferential export buyer's credit, which is a preferential, it's not foreign aid, but it's a preferential rate for export buyer's credit. So I don't know, I imagine in Latin America that you don't see those instruments very often. Maybe in the Caribbean, you would see that kind of instrument operating. But so that's one important distinction, I think, in terms of the lender and why those lenders are different, because the incomes in Africa, by and large, are lower. So in terms of what's going to happen now, these are really important questions and very interesting. So these liquidity needs, I think right now, you're right to say that it's liquidity, and it's not really a question of insolvency. So the last debt crisis did get to that point where it really was bankruptcy for these countries, and they didn't have any way to do it except to be allowed to exit. But right now it's liquidity, and where is that liquidity going to come from? I think from the Chinese, we don't see very much possibility of new lending going in that would provide liquidity, like IMF lending can do that. So that in Africa, there's only one example that we have of refinancing, and that was in Angola. So that to send in new money, that's probably not going to happen. And so it would be in some form of restructuring. So in the past, the countries that got restructuring got extensions of the repayment period. And there are a lot of different ways in which this was done. Sometimes the interest rate was lowered, and we recommend, to the extent they're listening, we recommend lowering of the interest rate in countries where loans are provided at commercial rates. So look at the situation of the country, IMF guidance on that, which countries should not be doing non-concessional borrowing, certainly now. So help them out by lowering those interest rates. And then also the extensions of the repayment period, and sometimes providing continued grace periods. We have heard from Xi Jinping. He's been talking about right now extending the DSSI. That has to be, or it should be anyway, a G20 decision. So they were pretty quick to come up and come to this conclusion. So having the G20 meet again to extend it, I think it's probably not going to happen right now. They're going to wait a little bit. But I presume in the fall, if it takes until then, or perhaps even sooner, we'll have a G20 decision on lengthening the debt service suspension period. And I think the Chinese will go along with that. But in terms of extending it to the other countries, again, we see more examples of this extension of repayment period. It's actually pretty common in Chinese lending, and this goes back for decades, that they have, even when they weren't a big lender, they did extend the repayment periods pretty easily. So we expect that will happen. And there's an interesting case in the Maldives. It's the only country that I've seen so far where the debt service suspension initiative negotiations have been concluded with China. And they've reported what the results were. And China actually agreed to a 4-year suspension. So the whole package involves 4 years. I don't know all the details of it, but it's not just through this 8-month period. So that kind of thing if China could, it's going to be difficult domestically in China. But if they could come out and sort of get ahead of the Paris Club or the IFIs and say, okay, we're going to do this, and we're going to extend it for an even longer period and be the leader on this, it's probably unlikely. But what a great public relations and contribution that would be to the situation. So to sum it up, I think the most likely thing is to have extensions of the repayment period and perhaps an extension of the grace period. And it's possible that a few more countries will be crowded into that.
Thanks, Deborah. I encourage everybody on the webinar to take a look at these more in-depth working papers that really give even more insight than that. We've got a whole bunch of questions now. We're not going to be able to get to all of them, but we've tried to cluster them into some some into so we can answer a bunch at the same time. The first thing I should report to your whole group is that half of them are just praise and thanking you for creating this incredible public good for everybody. Why don't I ask 3 or 4 and let you folks react, and then we'll go back and see how many rounds we can do in between now and 11 o'clock, if that's okay. I'll start with one by Ugo Ponitza, one of the he's one of the leading scholars in this whole space. He says, great presentation and great public good. Debt data in most income countries are collected through 2 main systems, one managed by UNCTAD and one by the Commonwealth Secretariat. You mentioned that Eritrea's data reporting quality is affected by its problematic relationship with the World Bank. Have you explored if the data collection system also matters? That's Ugo's question. Then we have like 3 or 4 questions that are asking you folks to differentiate or explain the difference in your methodology with other groups that are collecting data in this space. One is Aid Data, a terrific group at College of Williams and Mary in the United States. And there's another question about how your data compares and differs with these new estimates by Horn, Reinhardt, and Trebesh. That's a second cluster of questions, a whole bunch of them about that. Let me see. One from Tyler Botzon. He asks, in countries with oil secured loans, such as Angola, are the terms of the original loans renegotiated when the global economy's oil prices collapse? And why don't we leave it to those 3, and then we'll go for another round after that.
Thanks, Kevin. I guess I'll start out and then I'll turn it over to Kevin Acker and Yufan for their comments as well. So for Ugo's question, we actually don't know about how it works inside the countries, because this has not been a focus of our research, so we can't comment on that at all. But it's quite interesting, and to the extent that these 2 organizations are helping Eritrea, I would imagine that I've actually looked at the World Bank's commitment data long ago. They shared it with me. It was about 2007 or 2008. And I noticed that they had some placeholders for some of they had some estimates for countries that weren't reporting. And it was the data was a lot worse at that point. But they were not saying that all of their data was perfectly accurate. But it does seem as though that there would be other sources that they might draw on, but that would get quite complicated. In terms of the difference between our method and Aid Data, I'm going to ask my researchers who are very familiar with the Aid Data approach to see if they have something to say about that. I'll just say one thing in particular is that the Aid Data approach is they're very, very transparent, and they really want to be helpful to researchers, and I applaud that. One of the things that they do is publish one line, which is they have commitment data, or what they call pipeline data. So one is a pipeline commitment, and one is pipeline pledge. And I think researchers don't always distinguish between those 2. The pipeline pledge is much more in the category of what we would call an MOU. And we don't ever include that data in our public data, because we think it can be quite confusing to people that are not being careful to look at that in order to see what the Chinese are actually doing, because quite a bit of that pipeline, those pipeline numbers, just come from media reports and their hopes rather than real expectations for what funding will happen. So let me turn it over to Kevin and Yufan if you want to say anything else about our difference. And also with the Horn, Reinhardt, and Trebesh data, we haven't compared our data, or the new World Bank data, I think, is the more interesting comparison to see, because Horn, Trebesh, and Reinhardt have they released data on loan, their estimates of debt. So to compare that with the World Bank, the actual figures on debt, I think would be quite interesting. But I do think that, at least the way I see it, a lot of the issue is what assumptions do you make about disbursement? And as we saw in the Nigeria case, it's really quite dramatic, the difference between loan commitments and loan disbursements. It can lag for quite a long time for a number of reasons. So let me see what Kevin and Yufan have to add to that.
I'm going to talk a little bit about the aid data methodology and us. So I did a brief comparison of our data and aid data's data on Nigeria alone. So we just want to mention that since the aid data only have the data from 2000 to 2014, so our numbers will be more updated just because we'll update until 2018. And also by comparing the projects and the numbers and the loan amount, we noticed that we simply have more information than the aid data. I think also because we focus only on Africa and they focus on around the world, China's lending around the world. So if you use the aid data, so here I can see that for several projects that we both have, aid data overestimate amount because they cited some media reports. And we tend to go directly, and we tend to spend more time in this research and go to the official source, either the borrower, either the lender, or the contractor. So when we compare, we notice that aid data overestimate about 600 million in Nigeria than us, only from 2000 to 2014. And also we notice that aid data miss about $1,800 million of dollar project in Nigeria. I think that's because we go back and check a lot of the loans after 2014 and after aid data published the report, published their data. So a lot of projects only got confirmed after that. So for that, and I'll leave it at that.
Thanks, Yufan. I can address a little bit about the Horn-Reinhardt and Trebesch data. So the data that they released is data that they've calculated on disbursement. So I just will echo Deborah's comment that it would be really interesting to compare that to the World Bank DSSI data. They did use loan commitment data in significant parts of their analysis, and I think they've told us that they did rely some on our data, and they've published a blog where they've compared our data. So in some cases it's similar, in some cases it's slightly different. I know that they mentioned that they do include loans to private companies in Africa, and we do our data is exclusive to government borrowers and state-owned enterprises and other enterprises that have some government ownership. And I can to talk a little bit about the difference, the media reporting issue. I saw a question in there about 27 billion announced by Nigeria that they were going to borrow from Africa, or sorry, borrow from China, and this is why it's really important to verify loan commitments, because China has never lent, as far as we can tell, or offered a $20 billion loan or $20 billion line of credit. That $20 billion includes the project costs and I remember reading some reports about this, that sum includes the project costs for a number of projects that Nigeria would like to finance, and they hope that they can apply and receive funds from China Exim Bank. But the way that those loans are going to come into Nigeria is on a loan by loan, contract by loan commitment by loan commitment basis, and that'll, there will be no $20 billion loan to Nigeria, and if there is, that's unprecedented. And then I can address a little bit the last question about what happens when up to renegotiations of terms of loans when the oil price collapses. So the answer to this is yes and no. We did see both in Angola and the Republic of Congo, two countries that rely heavily on oil exports to finance their state budgets. In Republic of Congo, in both countries, they were granted a restructuring in the case of Republic of Congo and a refinancing in the case of Angola. The loans in the Republic of Congo, about $1.6 billion worth of outstanding debt on 8 loans. The repayment periods were extended and the interest rates were lowered. In Angola, loans that had been extended to the state-owned oil company Sonangol were refinanced through a line of credit from the China Development Bank. But in both of these cases, we have some evidence that these loans weren't explicitly oil-backed. We have from a source, we haven't been able to verify this, but We know that not all of the Republic of Congo's loans were oil-backed, and we have from we've heard from somebody in Republic of Congo that they think that none of the loans that were restructured were oil-backed. In Angola as well, a lot of these state loans were officially tied to oil via these escrow account arrangements, it was the loans to the state-owned oil company Sonangol, which would have the repayment of which would of course depend on the oil exports, but which we're not sure whether they were explicitly tied to oil in the same kind of escrow account arrangement.
Let me just add one more thing to this about, are the terms renegotiated? We don't have hard evidence of this in Angola, but it does seem as though, because the way the loan, the terms work is that the repayments, the money that goes into the escrow accounts it's done by the barrels per day of exports. And so that's calculated with an assumption of what the future cost is or price is going to be. And then when that price changes, there can be some sort of informal negotiations or sometimes formal negotiations about how many barrels are going to be exported to China and go into those escrow accounts. So that kind of shifting and adjusting goes on, but it's not sort of a formal restructuring of the loans or the arrangement. And Kevin, maybe you know more about that from the Latin America situation that you could shed light on. We know certainly in Venezuela there was a debt, there was a moratorium on principal repayments for 2 years, and then that ended.
Yeah, there hasn't what has now come to light early on in a lot of this research. Folks thought that China was locking in a country to the prices in the early 2000s, which were relatively low, and then there was a whole narrative about how China was reaping windfall prices when the prices were really high. But as Deborah said, in our Latin America analysis too, it's more about the barrels a day. And so unfortunately, or fortunately, depending upon what a day gives you, you're selling it at what the market price will be on a given day. One thing I'll add about just to clarify on the Horn et al. Comparison with you folks, the Horn et al. Data set is a collection of all of these data sets. So they, as their first input, their Africa data largely comes from the CARI group, but as Kevin said, they're also adding some private sector stuff in there. And they do go through and drop some and add some here and there. But their first order was pulling together aid data, BU GDP Center, CARI, Merrick's, Rhodium Group, a whole bunch of folks who have been looking at different regions to try to put together the first sort of and most up-to-date global estimate, and theirs goes all the way back to 1949. Let me move to some more questions here. I'll skip the fact that every question says, "Great job, way to go." Here's one from Emma Schleifer. Saying, I'm wondering, considering that the Chinese government often classifies aid quite ambiguously, how do you see Chinese aid fitting into the Western conception of this lending ecosystem? Then we have a question from Yan Wang. Do you think the IMF's debt sustainability framework using debt to GDP or debt to GNI is too narrow, which does not take into account the public asset that has been built for the host countries or for all of Africa? Another one is from Anna Alves. In the beginning, you mentioned that a handful of countries do not have any loans from China. What explains that? And just one more, I guess, from Joris Mueller. Could you please give a few more details about the commitment versus disbursement of loans? My understanding is that many of these loans are directly dispersed to Chinese contractors that are financed by the official loans. In addition, your group mentioned that loans are only dispersed after certain criteria are met by the borrower, and this takes 5 years on average. What are these criteria typically, and how do these processes work in practice? Can you recommend any other readings where we can learn more about this?
Thanks for those. let me start with the aid question as an ambiguous classification. I think the Chinese have their own classification of aid. It's not really that ambiguous. They have in their aid portfolio, they have the zero interest loans, which are fully, they're fully accounted for in China's annual budget. And so that's why they're easy to write off, because they don't have to actually allocate new funds, which in the Paris Club system, countries that write off loans have to allocate new budgetary funds. So this becomes an issue in their parliaments. Or at their Congress, as it would be the case here. So for all other loans, they provide a subsidy, but they're actually provided by the banks themselves who raise their money on bond markets. So the other foreign aid instrument is the concessional loan. So both of these are the Chinese are very clear about. These are the two instruments that are used for aid. Then they have these subsidized export credits, which in the OECD system, that is done of the labels that are applied in Paris that have been agreed to by countries in the OECD, export credits that are subsidized are never considered official aid. And so those don't go into the aid statistics. And so for the Chinese, they also subsidize that out of a different budget line. So there are, just to say that there are clear rules, I think, in China, which are not all that different from the rules that are applied by the OECD countries for their lending. So in terms of Yan Wang's question about the debt sustainability analysis and development sustainability, one of our colleagues, Johanna Janssen, has done a really nice analysis of this that you can find on our blog in looking at how the new debt sustainability analysis framework that was published by the Chinese, I think it was just last year, how that relates and how it's different from the IMF's. And I think what the Chinese framework still does emphasize is the contribution that a loan can make to the future repayment abilities. And they think that the IMF, in looking so much at the current situation in terms of whether or not a country should borrow, doesn't take enough account of, as you were saying, Yan Wang, of that creation of a public asset that can then contribute to development down the line. And we would say that there are some good points that the Chinese have been making in this. But at times like now, where there's an unprecedented global shock through the pandemic, it points out the frailty of the Chinese approach looking at this, because what's happening now is that these assets are not producing the kind of income that could repay these loans. And so they do become part of the problem rather than in the future, they may be part of the solution. And this gets down to the question of whether or not these countries are facing a liquidity problem or insolvency. And right now we're hoping it's liquidity. And so they're going to move along until the recovery happens and then come out of this rather than have to go into Chapter 11. So in terms of Anna's question about which countries, I'm going to let our researchers, Kevin, to take that one. And the commitment versus disbursement, I'll just say a few words and then our researchers can add more on that. But it isn't, I don't think anyone has really written this up. It's something that we hope to elaborate on soon. But there are a number of conditions that countries need to meet. And one of the most obvious is they have to supply, these are infrastructure projects. They all involve land. And so this is a responsibility of the host government. They have to supply the land. And that's often a long, complicated process. The land has to be bought. It has to make arrangements. People have to be resettled. So that can take a long time. But the other thing is that most of these loans, with the exception of the concessional loans, which the Chinese bank can finance 100%, and then the zero interest loans, they also can finance 100% of a project. All the other loans, the Chinese banks only finance 85%. So the government has to come up with another 15%. So that can also be a complicated process. And there are other things, like many countries require, even though there's a high degree of untransparency, a lot of countries do require that these loans be approved, these loan arrangements be approved by their parliaments. And so that's a process of taking it through the parliamentary procedures. And we can see that creating lags for a lot of countries. So the fact that they take 5 years or longer doesn't mean to start dispersing, though. That's to complete dispersing. So that's another point I wanted to make there. So Kevin, over to you. Kevin Ecker.
Sure, yeah, and I'll emphasize regarding the disbursement issue. I think there are plenty of situations where there are cases where countries are having difficulty coming up with their share of the 15%. And I can point you to both Zambia. There's a road that's like the C400 in the Copperbelt province of Zambia, that the loan for which was signed back in 2015, and we have it on government documents that this loan was signed. But as of, we were seeing media reports as of 2019 that the project still had not been able to get off the ground because Zambia hadn't been able to come with their 15% portion. Cameroon's another good example, and there are some Cameroonian media reports that kind of walk through some of the different issues with some of the different projects that were seeing really slow disbursements and implementations. But other than these specific issues, a 5 to 6 year disbursement period can often just reflect the speed of project implementation. Construction, especially of things like hydropower projects, takes a very long time. And in Nigeria, the Zungru hydropower project has taken, the loan was only partially dispersed 7 years after it was signed. And the Chinese bank, my understanding is that the Chinese bank will only disperse the loans, Export-Import Bank will disperse them directly to the contractor as the contractor incurs costs. And sometimes only after the contractor has incurred some significant costs, as sometimes contractors actually start projects before the loans are, sometimes before the loans are committed. That's another issue. But in terms of the countries that don't receive, that haven't received lending from China, and these countries that are Somalia, at least in 2000 to 2018, these countries could have received loans before this period, but this is Somalia, Libya, Sao Tome and Principe, and Eswatini. Eswatini is a really easy case because it's the only country in Africa that still recognizes Taiwan. So it doesn't have formal diplomatic relations with Beijing and doesn't get loans from China. Sao Tome and Principe, they actually include $10 million of outstanding debt to China. But we think this is from the China International Fund, which is actually not from China. It was based in Hong Kong and is now, as Deborah mentioned, based in Singapore. And this was a $30 million loan that was kind of shrouded in secrecy and controversy. Only $10 million it was disbursed before actually the president of that company was arrested for corruption. But we don't record that 10 million in our data because it's not coming from mainland China. As for Somalia and Libya, I know less about these cases. This could be a matter of just data and availability. There could be some loans that we just haven't been able to find. Or at least in both these cases as well, there's been serious kind of civil war and civil strife. And we think that this might also be a roadblock to lending. You found her, Deborah. Is there anything to add?
I would just add a little bit on the disbursement process. So the total cost never got dispersed directly to the contractor, like Kevin said. When the project reached a different stage, the bank would disperse a certain amount of loan, and also the borrowing government also need to pay their share 15% in terms of reaching different stage of the project. And a lot of time we see that, some government was able to pay the 15% at a very, very early stage, but as the project got implemented, they run into different kind of crisis and they stop paying their share, and the Chinese bank would stop dispersing a loan as well. And there's another situation that when these borrower have repayment issue with Exim Bank, it's also likely that Exim Bank will suspend the disbursement for certain project. So it involves a different thing, and the loan never got dispersed just right away, a click like that. Yeah.
Great answers, folks. I think we have room for just one more round. I'll read a couple. Maggie Zheng asks, how do you verify whether or not a loan has been executed or not? You go a little deeper into your methodology there? Somewhat related is, have you, and this is from Amira Woods, she asks, have you established partnerships with any African universities so that these data, procurement and analysis and knowledge production is not solely US based? They slip in a question for me there. They said, can you say a bit more about the special drawing rights and why so few would be allocated to Africa? And then one from Samuel Croy, who asks, has there been any cross-mapping loan data with corruption issues? Much journalism on this issue associates the opacity of the BRI in Africa as indicative of payoffs to officials. That's all I have in my chat here. Why don't you ask answer those three and make some final remarks.
Well, I think these are, I want to turn some of these over to my, especially the how do we get the status of the country, because our research team is really experienced in how they do that. So I'll let them answer that. In the question about partnerships with African universities, we haven't done this. Informally, we have a lot of relationships, but we haven't done partnerships. This is institutionally quite complex. Every time you add, another institutional partner, it becomes more complex, as we've discovered in having some formal relationships with other institutions through some of our other research work. But it's actually a really great idea, and my brain is sort of going, how can we do more of that? So thank you for that suggestion. And in terms of the corruption, I'll address that briefly. This is something that I think is really an issue with Chinese lending, and it's in part the whole, I would say the structure of it is that Chinese lending works, it's a sort of a request-based system, so that they don't, like the World Bank or USAID, they have whole departments that develop country strategies, and they come up, foreign experts come there and they kind of decide together, they do visit the country and they talk to them, but they come up with their own ideas really about what the country needs, and then they fund those things. And it's not always what the country itself wants. There is an exception. The Millennium Challenge Corporation, I think, is pretty close to funding what countries want. So that's one of the, I think, the best exceptions to that. But so what this means on the Chinese side is, because they don't have all of these people going and developing strategies for what the bank will fund, they rely on the governments to actually tell them this is what we want to borrow for. And then that provides a huge opening for the contractors, the Chinese contractors, to lobby these governments for their particular projects. So they find out that the government has been wanting for 20, 25, 30, 40, 50 years to fund something, could be a port or a railway or a hydropower project, and they haven't been able to get finance. And so that contractor can develop the project, and with the government, they can shepherd it to the banks for funding. And because the banks don't have their own personnel to do all that project development themselves, this provides an opening for payments systems and percentages and paybacks and all of those kinds of corrupt practices. So it's really a weakness. And we saw this at an earlier era with Japan, which also used that kind of system for a long time. And they had quite a few scandals until they reformed that system. So it's a big weakness in the Chinese approach. Over to you, Kevin.
Sure, yeah, I can talk a little bit about the question of how we figure out whether a loan has been executed. For this, we can only really do this for projects for loans that are to finance specific projects. There's some interbank lending to state-owned banks in Africa, for example, where there's no project associated with the loan. We can only rely on, for example, annual reports from banks and to see how much has been dispersed in a given year. But for loans that are associated with infrastructure projects, oftentimes the projects are reported on in domestic African media sources. So every year when we revisit these loans that have been signed, we check to see if the construction has started, and in what stage of the implementation it is, and only then do we move it from our signed status into implementation. The source, like I said, the source for that, another great source for that is, in addition to African domestic media, is Chinese contractor websites. So very often, big Chinese contractors will post on their websites updates about the progress of their projects in Africa. And if we don't find any evidence of implementation, if the contractor has said nothing about a project for 4 years to be specific, and if we haven't seen any domestic media say that the project has been implemented, that's when we start to get suspicious that this loan is being implemented, and that's when we actually take it out of our loan totals until we do see that a project has started there.
Well, great, folks. We've got a couple more minutes. Does the team want to make any final remarks? Let us know about new publications or new webinars that you have coming up for in the future.
Let me say a few things, which is that we've had some questions asking us about, what kind of analysis we plan to do with the data. We have a whole research project that we've launched this year, which is together with a number of research partners analyzing this data. But it's available out there for you all. So you can download the Excel sheets and you can do the analysis yourselves now. So our data is, there are lots of different questions that could be answered. We're hoping that you will go ahead and answer them. And we look forward to seeing the results of that. So again, I couldn't be prouder of my team. They've done, led by Kevin this year and people in the past. Janet has been our project coordinator before Marie joined us. And Jijong Huang also was one of the leaders of the data collection effort. And she worked for us for 4 years in that role. And, and so and Jordan Link, worked for us for a year as well. So all of them deserve a lot of credit for this, for the database launch that we did today.
Great, folks. Well, thanks so much. And congratulations again. For those of you out there on the webinar, be sure to go to the CARI webpage, www.sais/cari.org. Where you can download this data for free, play and look at the displays right there on the web, and download all the rich working papers and other associated research that this great group is doing. And monitor their webpage and sign up to get alerts from them so you can find out about other great webinars like this. Have a great day, everybody, and thanks so much for coming.